Hello, David Morgan with you for the weekly perspective. Well, one from the Telegraph is the UN fears third leg of global financial crisis with prospects for epic debt defaults. The article starts, the third leg of the world's intractable depression is yet to come. If trade economists at the United Nations are right, the next traumatic episode may entail the greatest debt jubilee in history. Interesting words. I will not read the whole article to you, but it's interesting that mainstream, and it doesn't get much more New World Order than the UN, making statements like this. So it means we should all pay further attention to what's really going on. So finally, in this article, I'll highlight the fact that the UN's advice to the emerging nations is to retake control of their destiny and turn the tables on the financial elites. Quite a statement coming from the UN. They should impose capital controls, preferential tax treatment for retained earnings, and force fund managers to hold assets for longer. They should allocate credit without apology and learn a trick or two from the Korean methods of financial repression. Interesting who's going to enact it and who's going to put up the regulations, etc. But nonetheless, very interesting article. From Economic Collapse News, central banks have been net gold buyers every year since the economic collapse. This report. This is very interesting. I think most people that follow my work and others in our meme know that the central banks have been net buyers for several years, and it's probably going to accelerate. And the last article I'll show you right now is from Wall Street. The Fed is steadfastly blind to bubbles and their consequences. The OECD warns the Fed, Bank of Japan, and the European Central Bank of asset bubbles, risk to financial stability, and pinpoints U.S. stocks and real estate. What I find interesting here is the third paragraph. The Bank of Japan will target 0% yield for a 10-year Japanese government bond, which has been negative for months. So it's trying to push up the 10-year yield a smidgen. Shorter maturities would still sport a negative yield. This would steepen the yield curve. In effect, the Bank of Japan will control the yield curve. By the end of the year, it might own 50% of all Japanese government bonds. And here's my sentence I love. Why even pretend that there's still a bond market? Maybe it's just for entertainment. Folks, we're getting close to the end in my view. Bond markets are the key. And I'll now talk briefly about the precious metals. Both gold and silver are consolidating, and we're in a sideways trading range. And we really don't know exactly which way the market's going to go until it breaks through that trading range to either the upside or the downside. As I said in my recent Morgan report and in the public domain, that most surprises from now on will probably be to the upside. Does not mean that there will not be some nasty corrections that may scare people out, and there may be some long consolidation periods that may wear people out. But nonetheless, gold and silver are certainly strong in the 2016 timeframe and will continue to do so, ultimately probably setting new highs at who knows what paper price, but will be substantially higher than the $1,900 level gold has already achieved and the $50 level that silver has already achieved. So that's the wrap up for this week. Let me know if you like the format where I actually show you the articles, or if you just prefer me to voice the interesting spots that I found during the week. That's it for this week.